Hey everyone, welcome to the Stock Fundamental series, where I break down complex financial concepts into easy to understand bites. Today, we dive into the core satellite portfolio strategy, a powerful approach to build a diversified and dynamic investment portfolio. Let's get started. What is a core satellite portfolio? Think of it as a two-part strategy. The core is your sun. It's the stable part where you invest 70 to 80% of your total investments and provides consistent returns. These are low cost, diversified investments like index funds, ETFs. They track major indices like S&P 500 or Nifty 50. The satellites are your planets, which revolves around the sun. It is the more flexible, tactical part where you invest 20 to 30% of your total investments. These are smaller, more adventurous investments like active funds, individual stocks that allow you to take advantage of market opportunities and trends. Whether you are a seasoned investor or just starting out, this core satellite portfolio strategy can help you balance stability with growth. Together, they create a balanced and adaptable investment approach, combining best of the both worlds. Let's break it down further with an illustration. Suppose if you like to build a house, the core is your foundation. The goal here is to capture the overall market's performance over time. As you don't change your foundation often, similarly, funds invested in core should be invested with long term horizon. It's your set it and forget it component, providing steady, reliable returns with lower cost and lesser risk. The satellite is your roof of the house where things get interesting. This part of your portfolio is more active and strategic. It may have higher cost and higher reward as well. Investments here may have shorter time horizon. In addition to the roof, you may have a garden, a driveway, a garage, and a car. Similarly, as part of the satellite portfolio, you can invest in specific sectors, themes, asset classes that you believe have the potential for higher returns. For example, you might allocate a portion of your portfolio to tech stocks, emerging markets, or green energy areas that you think can outperform the broader market in the shorter to medium term. To summarize, the core makes up 70 to 80% of your portfolio, while the satellite accounts for 20 to 30%. This allocation ensures that your portfolio remains balanced and doesn't become too risky. The core provides stability while the satellite allows you to take calculated risk and potentially boost your overall returns. One of the biggest advantage of the core satellite approach is its flexibility. You can adjust the satellite portion based on market conditions, economic trends, or your personal investment goals. For core portfolio, these are some of the index funds, ETFs that you can invest across different regions like US, UK, Europe, and emerging markets. For satellite portfolio, these are some of the actively managed thematic funds that you can invest across different regions like US, UK, Europe, and emerging markets. Moving to the key takeaway sections, if you are a beginner, start investing in the core portfolio to 100%. As Proverbs says, once you get the wisdom and understanding, slowly you can step up to invest in satellite portfolio based on your risk appetite. But remember, with great flexibility comes the need for discipline. It's important to rebalance your portfolio regularly to maintain your desired allocation. This helps you avoid overexposure to any one of the areas and ensures your portfolio stays aligned with your long term goals. If you found this video helpful, don't forget to like, share, and subscribe for more financial insights. If you have any questions or topics you would like us to cover, drop them in the comments below. Thanks for watching and happy investing.